Hello and welcome to this quarterly update for the Airlie Australian Share Fund. My name's Felicity Haynes, Head of Wholesale at Magellan, and today I'm joined by Portfolio Manager Emma Fisher and Deputy Portfolio Manager Joe Wright. Thanks, guys.
Thank you.
Emma, a very volatile quarter for the market, and we're continuing to see some markets melting down. How have you and the team been navigating this period?
Yeah, look, I mean, it begs the question, is it still called volatility if markets have only been going down, which is definitely the way that it feels. I think the market peaked in mid-February, and since then, the ASX 200 has fallen nearly 17%. The US markets have fallen over 20% from their highs. In terms of how the portfolio navigated the volatility last quarter, so January and February were actually quite good months for us, particularly February, where we saw the first cracks in that hyper bank rally that's dominated the ASX over the last 12 months. And disappointingly, I suppose, in March, we did get sort of swept up in a lot of this volatility. Basically, anything with US exposure has been sold off on the tariff concerns. And I guess that where that leaves us in terms of our portfolio, 5 of our top 10 holdings have large US businesses. So businesses like ResMed, BlueScope, Aristocrat, which have been fantastic long-term performers for us. They were really hit quite hard in March. In terms of, that volatility has continued in April. It's always very difficult to call a bottom. Like one interesting statistic I find is that if you look back at the last 12 recessions in the US since World War II, on average, they fall about, the markets will fall about 25%. And so obviously we're about 21% now. So to me, that would suggest we're closer to the bottom than anything else. And then obviously you're always looking for the soft signals as well. I think this might have happened to Joe as well, but the other day when the ASX was down 4%, my mum called me. She sounded very concerned about my mental health. So, when you're getting family members calling you because you work in markets and they're worried that you're about to jump out a window, that's usually a sign again that maybe you're somewhere near the bottom. I think maybe she was quite surprised to hear that I was actually very excited about the market sell-off because, in our view, if you're buying businesses that have really good balance sheets, and the bulk of our portfolio have phenomenal balance sheets, the lower the share price goes, the lower the risk. And so in terms of where we're adding to in the portfolio in this market sell-off, there's really 2 buckets. So firstly, there are those US exposed businesses where the balance sheets are pristine and we know they're going to survive any sort of downturn and really thrive on the other side. So these are businesses like BlueScope, ResMed, News Corp, and Aristocrat. So we're adding to those positions. Where we're holding off on those US exposed businesses are those that have higher levels of gearing. So I'm sure we'll come to our views on the James Hardie deal, but that would be an example of a business where they've gone and effectively geared up their balance sheet into a potential US recession. So we're not adding to a position like that. The other bucket where we're seeing a lot of opportunity is Aussie exposed businesses that are exposed to the consumer and particularly exposed to an improving consumer. So, in many ways, the US and the Australia consumer have had very different opposite journeys. So the US consumer is coming off the back of a couple of fantastic years. They haven't felt the interest rate pain because they're all locked into these 30-year mortgages. And, stock markets have been going up and their house prices have been going up. So they're sort of rolling off that now. Whereas in Australia, we've had this, very dark, deep winter of a per capita recession. And now we can see the light at the end of the tunnel, which is interest rates falling. And if anything, this market volatility has probably accelerated the path for interest rate cuts. So that should be a good thing for domestic-facing, consumer-facing businesses. So we've added JB Hi-Fi to the portfolio. And the other beneficiaries in the portfolio would be businesses like Charter Hall that will benefit from lower interest rates. So we're adding to that in this sell-off, as well as businesses like Scali and Premier Investments.
And Joe, Emma mentioned those US exposed businesses. One of those is BlueScope, and I was just hoping you could talk us through how the tariffs impact BlueScope, but also why it still remains as a top 10 holding.
Yeah, no problem. So BlueScope is a steel and steel building products producer with operations in the US, Asia, and Australia and New Zealand. In the US in particular, they operate an electric arc furnace, North Star, and a collection of midstream and downstream building products, steel and steel building products assets. The news and the noise around tariffs has naturally drawn a lot of investor focus to the earnings implications for the US part of their business. A few comments. Firstly, in the short term, the tariffs has actually seen steel prices and steel spreads increase dramatically in the US, which will benefit the earnings base of North Star. Medium term, there's a few more questions around US demand and economic growth. We take a lot of comfort in, firstly, the position of North Star on the US steelmaking cost curve. Secondly, the strength of BlueScope's balance sheet. And then thirdly, the fact that actually a lot of BlueScope's earnings are generated outside of the US. Put simply, we see a long-term, big structural earnings growth opportunity in BlueScope. That gives us the comfort to look through short-term cyclicality in earnings, because we think the business is very undervalued and has a great balance sheet and management team.
Joe, Emma referenced the James Hardie deal, and it's fair to say the market have not loved the acquisition of AZEK. How did you view it?
So we own James Hardie because we believed there was a fantastic long-term structural growth opportunity in US siding, the material conversion of things like vinyl and other materials to fibre cement, which James Hardie produces. It's a fantastic long-term story, and sort of buoyed by the fact that through the cycle, James Hardie's earned fantastic return on capital. This AZEK acquisition changes the thesis for James Hardie materially. In our view, they've paid a big price for a business of lower quality. That dilutes our exposure to the core siding business, which we love. It also dramatically changes the return on capital profile of the business. AZEK is a good company. There's a long structural earnings growth story there, similar to US siding. They produce PVC and composite decking that is taking a lot of share from traditional wood decking. We like the business. We're just concerned about the price paid, and we didn't think James Hardie needed to do a deal of this size. So if we look now at the business under our process, we've lifted leverage significantly to fund the acquisition. Business quality has arguably reduced as the return on capital of the legacy Hardie's business is diluted by the size of the acquisition of AZEK. There are question marks around capital allocation from a management quality perspective. And so the final piece for us is valuation. The share price has fallen 30% since the deal was announced. And so we're doing a big piece of work at the moment to properly understand AZEK and understand the extent to which this fallen share price is or isn't compensating us for the changes in the first three factors of our process. And frankly, we want to make a decision that has a long shelf life. That's why we're going to do a big piece of work around this deal, and we are doing that work at the moment. And we believe, making decisions with long shelf life is the right thing to do by our investors.
Thanks, Joe. That's going to help us with some of the questions that are coming through. A couple of the Airlie team members have had some recent overseas trips. Emma, can you just talk about some of the takeaways from the travel?
Yeah, sure. So Vinay Ranjan went to the UK. Actually, he went to Paris for the Macquarie Investor Day. So, nice work if you can get it. But he then headed over to the UK, and he spent some time with the guy that's heading up the UK expansion of Nick Scali. So Nick Scali bought this business, Fab Furniture, and basically it was a very tired old furniture retailer, and they have been converting Fab Furniture stores into Nick Scali branded stores and swapping out all of the product for Nick Scali product. So Vinay went out and saw one of these stores just outside London. He also visited a couple of competitor stores. And basically his main takeaway from that is the fact that, the Nick Scali product it's very modern. It's what they sell in Nick Scali here. And when you go into these competitor stores, it's very tired, daggy product. Like it's not even like boomer sort of taste. It's like Great War generation, reclining leather lounges, like cup holders in the seats, that sort of thing. So, obviously, I don't want to discount that potentially that's just the UK market's taste. But, one thing that we're buoyed by is the fact that at the most recent result, Anthony Scali, the CEO, pointed out that the best-selling lounge for these UK converted sites is actually the same lounge that's the bestseller in Australia. So to some degree, that anecdote suggests that there may be some portability of tastes. That the business, the stuff that's selling in Australia will sell in the UK. So it's a bit of a watching brief. They haven't bet much on this acquisition. The last thing you want to do is make a big, capital-heavy bet on an offshore expansion, and they haven't done that in this case. And obviously the size of the price is enormous, because if they can get it right, the UK is a population 3x the size of Australia, so it can support a lot more stores. So we were buoyed by what we saw. The other interesting meeting that he went up to Ireland and he spent some time with the CEO of Irish Chemist Warehouse. So Chemist Warehouse has been in Ireland for 5 years. They have 12 stores. They're opening more. And he went and visited 3 of those stores, and they were huge. It was a Tuesday morning, and they were absolutely pumping. And very similar to Australia, which is that format where it's just stuff all the way up to the ceiling, and people just can't believe the prices. We've actually heard anecdotally quite a lot of Irish Australians calling up their family back home, going, "You've got to go to these Chemist Warehouses. You won't believe how cheap everything is there." And so we think, the model is going to be very similar to Australia in the sense that you've got this industry in pharmacy, which is very protected. They earn very high fat margins. The average gross profit margin for a pharmacist is 40%, and they're quite small stores. Whereas the Chemist Warehouse model is to do these huge stores and massively undercut on price. So the gross profit margin that Chemist Warehouse make is around 20%. And, they can make that work because they're pushing so much volume through their store and they're really fractionalizing that fixed cost base. So, they end up in a world where their pharmacy competitors just cannot compete on the prices that are available at Chemist Warehouse, and they really drive a lot of foot traffic, a lot of word of mouth referrals that way. So we think the early signs in Ireland are very positive. We think that market could support at least 50 stores. And the really important thing about the Irish market is you've got the same main competitor in Ireland as you do in the UK, which is Boots. So if they can, effectively make it work and succeed against Boots as the incumbent in Ireland, then I would expect that it's sort of a watching brief that they could then enter the UK on a similar sort of market share dynamic. So that was really interesting. Joe also went to China on a trip, so I'll let Joe talk about his takeaways there.
Yeah, no problem. I spent a week in China. The main question I was trying to ask or answer for myself was, has recent government stimulus genuinely improved the outlook for the consumer? And is that then going to drive an inflection point in commodities demand? We visited steel mills, different businesses that are in the electric vehicle value chain. We spoke with consultants. My general sense was, yes, the consumer is perhaps in a better position than they were 12 months ago. That is not necessarily driving an inflection point in commodities demand yet. Most of the steel companies we talked to saw an order book that was flat to down. There is a lot of growth in the electric vehicle sector. A lot of that growth is not necessarily to the benefit yet of critical minerals or lithium rare earth producers in the form of price, given supply is reasonably abundant. More to the benefit of those, vertically integrated downstream players that are capturing a lot of market share. So it's a watching brief, something we keep an eye on. We're underweight resources currently, but always looking to test our view there and allocate, exposure, when we see appropriate.
Great. Thank you to you both for joining us today. It's been a really timely and insightful update. Thank you. And thank you to you for watching. I hope that this has been useful, and please feel free to pass on to any colleagues and clients that would find benefit. Thank you.